Well, happy Monday morning to you. I'm Marlon Bowling with you, your tour guide to the ag commodities. Gosh, we're glad you could join us today as we look at our ag trade and as we look at our ag commodity market action from overnight. Let's take a first look here at our quotes provided by Bar Chart. Well, we were higher overnight a little bit. We had March corn 2.5 cents higher at 6.48 3/4. Well, you know, that was only one tick away from its high of the overnight trade. Fairly strong performance turned in on the corn overnight. Check out soybeans. They seem to get a little stronger as we went. January was 46.5. That was up 8 cents and within a couple of pennies of its high of the overnight trade. March was up 7.25 when we wrapped up that overnight session. Now on the wheat market in Chicago, we actually had March closing 3.5 cents higher overnight at 7.64.5. That would put it at 3.5 cents from its overnight high. In Kansas City wheat here, you had the March contract 4.25 higher. Last trade 8.75. So that was within about 2 or 3 cents of its high of the overnight trade as well. On spring wheat, we had March 2 3/4 higher at 9.24. That was only one tick from its overnight high. And in the cotton trade, well, at last check, we had the March 146 points higher at 84.66 per pound. We have Brian Hoops on the line. He's the president of Midwest Market Solutions in Springfield, Missouri. All right, Brian, we had some, overnight deliveries posted at the Chicago Board of Trade. Wanted to get your thoughts on what these deliveries mean. We had Chicago wheat at 419 contracts, corn 291 contracts. I don't remember seeing corn last week. Kansas City wheat came in at 152, soy meal 13, soy oil 1. We ran out of space here, but I believe they had one contract on oats too. But that Chicago wheat and corn, does that raise any caution flags to you or not today?
Yeah, good morning, Marlon. Probably not a lot of caution in here because of those deliveries. They were down from what we saw a week ago and a few days ago, I should say. So, you know, our deliveries usually get less and less as the delivery period goes on. A lot of these are retenders. And so I don't think the market's really focused on this. Some of the news over the weekend is what we're trying to trade off of, and that's Argentina's weather forecast for this week looks to be pretty hot and pretty dry. There's not much rain, and it's going to be warmer temperatures than what is desired. Now, Brazil doesn't really follow that same weather pattern. They're looking at more of a better rainfall chances, not as much heat, but it's enough to give us some short covering, especially in soybeans, as you know their planting progress kind of gets further and further behind normal in Argentina. The other piece of information out there that is China is starting to relax some of their COVID restrictions. And this is not just a complete reopening of their economy, but you can see crude oil's up a couple dollars this morning off of this news, and it's spilling over in corn and soybeans that China's allowing some public interaction between the people, the citizens of their country. And so it's kind of an easing of the restrictions, but not a complete opening. Friday's has a supply and demand report, pretty much a benign report, but I think it is going to be a little bearish to the corn market.
You were talking about the situation in South America with production, but considering the fact that basis is still pretty strong here in the U.S., Brian, and the fact that the long-range predictions have La Nina fading out by the time we get to February, if that's the case, wouldn't that take the drought pressure off of South American production, and that could cause a hazard for our corn and soybean prices moving forward toward the spring here?
Yeah, you're right. If you look at the markets, it's a completely different market than anything I've seen in the last 25 years. You have the cash market stronger in the front months right now and telling producers, if you look at the cash, you need to be selling your cash now and buying something later. But if you look at the futures, it's the opposite. The futures are cheaper here in the front months, and the deferred contracts are building in a carry in both corn and soybeans. And so it's a different market than what we've seen previously. But it is telling you that if you have product that you're storing, certainly look at making cash sales and then look at the ownership opportunities. In Brazil, no doubt, and in Argentina for that matter as well, will try and undercut our prices once their harvest begins in that late January, February timeframe and continue into the spring timeframe. And so there's a small window here of opportunity, I think, where you have very strong cash basis levels yet before that product starts to compete with us, where you can make some really strong cash sales.
Excellent insight into that market. All right, we'll come back in a moment and we'll talk about this livestock trade a little bit as we get ready for a brand new trading week. I'm talking with Brian Hoops. We'll be right back. We're back with Brian Hoops of Midwest Market Solutions. Brian, you said you had a little news tidbit maybe off the wire this morning regarding some Chinese business maybe over the weekend.
Yeah, we saw some, export sale announcements last week, and we saw one again this morning. 130,000 metric tons of soybeans sold to China. So a couple cargoes being moved. I think it's strong and healthy for us to be making these sales at this time frame. There was some talk that last week Argentina had sold 6 to 7 cargoes of soybeans to China. So, I'm still waiting on confirmation of that, but it's certainly encouraging that China is buying from us during this time frame. And I think that'll help out our prices this morning.
Well, do you have any news on the livestock front that could drive the market one way or the other here today?
Well, we watched the packer margins and slaughter levels real closely for price direction. We had a pretty good slaughter week last week, over 660,000 head once again. But packer margins continue to slip. They're now estimated at about a negative $80 a head. And so in an effort to reclaim those lost margins, this may be a week where they start to slow those kill speeds a little bit. And that, I think, will take some of the steam out of the cash markets. We were fully steady last week, and I'd like to call things steady again this week. But, you have a feeling if they pull back on their bids, if they have some captive supply to work with, slower slaughter pace, that may limit the amount of cattle that they're buying, and it certainly may not have to bid up for that cash markets this week. So I wouldn't be surprised to see the cash kind of stall out, especially if these slaughter levels do peak and turn lower for a week or two.
All right, let's look at where we wrapped up last week then on the live cattle. And on our quotes provided by bar chart here, we had the February contract settling at 155.87 last week. That would have been 45 cents higher on the day. This is on Friday as we headed into the weekend. Again, those prices not that far from contract highs, so still up there at fairly lofty levels. Over on the feeder cattle side, we had the January contract on Friday $1.37 higher at 182.45. It was far outpacing all the other months, so it was all front loaded as far as the strength on Friday. And then on the lean hogs, well, we headed into the weekend with February up $1.22. It was at 90.42, and April and May were also over $1 higher. We'll see if we get any follow through here this morning. Brian, good to talk with you again. Thank you, sir. Appreciate that very much. Brian Hoops of Midwest Market Solutions. So, Tammy, the table is set. We're about ready to start trading at the bottom of the hour.